Every retirement calculator in America runs on the same portfolio: 60% stocks, 40% bonds. It's the default in your 401k. It's the number your advisor quotes. It's the shape of nearly every model you've ever been shown. Here's the part that doesn't get shown. Across the 1970s, that portfolio lost about 16% of its purchasing power, not in a crash. Over a full decade, 10 years of contributing, 10 years of staying the course, 10 years of doing everything the brochure told you to do, and you came out the other side able to buy less than when you started. And in 2022, the same portfolio had its third worst year on record, because the thing that was supposed to catch you when stocks fell harder. So the question isn't whether 60-40 works. In some decades, it works beautifully. The question is what happens to you in the decades where it doesn't, and whether you get to choose which decade you retire into. You don't. My name's Ben, and I've read 100 years of financial history so you don't have to, because every panic, every bubble, every tax surprise has a precedent. This channel runs the precedents. Today I'm going to hand you a 3-part allocation framework, tell you exactly where the structure came from, and then run it through the 3 worst stretches in modern American financial history. 1929, the 1970s, 2008. Real numbers, sourced, no rounding in my favor. And then I'm going to show you the year it failed. Because a rule that only ever wins is a rule someone is selling you. Let's start with why the standard portfolio breaks. A stock and bond portfolio is a bet on one specific world. It's a bet that prices stay roughly stable, that companies keep earning, and that when companies stop earning, the government's borrowing costs will fall, which makes your bonds go up while your stocks go down. That trade has worked well for about 40 years. It is not a law of nature. It's a description of one monetary regime. Change the regime and the whole thing inverts. In an inflation, bonds don't rescue you. They're the thing being destroyed, because you're holding a fixed stream of dollars while dollars are losing value. In a deflationary collapse, stocks don't just fall, they fall for years, and the companies underneath them stop existing. Which brings me to the sentence this entire video hangs on. You don't need to know which decade is coming. You need to own something that wins in each one. That's it. That's the whole framework. Everything from here is just arithmetic on top of that sentence. Let me put 2 people next to it, because percentages don't land until they have a kitchen table under them. Claire is 58. 600,000 saved, all of it in the default. A target date fund that's roughly 60 stocks, 40 bonds, and $11,000 in checking that she thinks of as her emergency fund. It's about 2 months of expenses. Marcus is 59. Same 600,000. Near enough the same income, same suburb. His is split 3 ways. A quarter in real assets, half in broad equities. A quarter sitting in treasury bills earning something boring. From the street, Claire is winning. She has been winning for 11 straight years, and she has the statements to prove it. Hold on to both of them. We're going to walk them through the same 3 decades. And the structure isn't new. It's the oldest allocation advice in the written record. In the Babylonian Talmud, Tractate Bava Metzia, page 42a, Rabbi Yitzhak advises dividing your money into 3 parts: a third in land, a third in business, and a third kept in reserve. That's roughly the 3rd century. Roger Gibson opened his 1989 book Asset Allocation with that exact line and translated it into modern terms. Land is real assets, business is equities, reserve is liquidity. 3 sleeves. One that holds value when money breaks. One that grows when the economy works. One that stays liquid when everything else is frozen. Now, let me be straight with you about the name of this video, because I'd rather you hear it from me than find it in the comments. Nobody carved a 25-50-25 rule into a tablet in 1936. The 3-part structure is genuinely ancient. The weights are mine, calibrated against 90 years of American data, which is the part I can actually show you. If you want a rule with a founder's name on it, this isn't that. If you want one that holds up when you check it, keep watching. Let's check it. Start in the worst place. September 3rd, 1929. The Dow closes at 381.17. That's the top. Over the next 34 months, it falls to 41.22 on July 8, 1932, an 89.2% decline, per the Federal Reserve's own history of the crash. The index does not see 381 again until November 23, 1954. 25 years. Now put yourself in that. Not as a statistic, as a household. You have some money. Your bank may or may not open tomorrow. In the first 3 years of the slide, roughly a quarter of the workforce is out of a job. Real output per person falls by nearly a third, and thousands of banks close their doors with people's savings still inside them. There is no deposit insurance yet. There is no unemployment insurance yet. If your money is in the wrong place, it is not down. It is gone, and there is no institution whose job it is to give it back to you. And here's the thing almost nobody accounts for when they picture the Depression. Prices were collapsing too. From October 1929 to the trough in April 1933, the All-Items Consumer Price Index fell 27.4%, according to the Bureau of Labor Statistics. That number changes everything, and it changes it in a direction people don't expect. If prices fall 27.4%, a dollar that just sat in a coffee tin gained about 38% in purchasing power. Doing nothing was one of the best trades of the decade, so run the three sleeves through it. The cash reserve, flat in dollars, up 38% in what those dollars buy. The productive sleeve, stocks, down 89%. Brutal. No way around it. The hard asset sleeve is where it gets interesting, and where I have to be careful, because there's a fact most people who tell this story leave out. Americans could not legally own gold. Executive Order 6102, signed April 5, 1933, required citizens to surrender gold coin and bullion at $20.67 an ounce. That ban ran 41 years. So a real American household in 1932 could not have held bullion, and any backtest that pretends otherwise is fiction. What they could hold was gold mining shares. Homestake mining was the largest U.S. gold producer, and it's the standard proxy historians use for that era. From the Dow's high on September 3, 1929, to its low on July 8, 1932, the exact window where the index lost 89%, Homestake's share price was up 49%. Its dividend went from $7 a share in 1929 to $56 a share in 1935, according to the reporting in Time at the time. The rest of the country was in soup lines. The gold miners were raising the dividend. Now put the sleeves together. 25% up 49%, 50% down 89%, 25% flat. In dollars, that portfolio is down about 32%. Hold on to that. We're going to make it better, and that almost never happens in this direction, because dollars aren't the point. Purchasing power is. Adjust for that 27.4% collapse in prices, and the portfolio is down roughly 7% in real terms. 7%. Through the worst financial event in American history. A household holding only stocks was down about 85% in real terms over the same window. Same country, same crash. Same 3 years. That's not a small edge. That's the difference between a bad 3 years and a destroyed generation. Now break the assumption. 1929 was a deflation. What happens when money breaks the other way? The 1970s. Between 1970 and 1980, consumer prices rose 112%. The dollar lost more than half its purchasing power in a single decade. Stocks were nominally positive over those 10 years, but after inflation, an all-stock portfolio lost roughly 17% of its real value. The standard 60-40 lost about 16%. Cash, sitting in treasury bills at what looked like healthy rates, lost about 13%. Every conventional option lost. That's what an inflationary decade does. It doesn't crash anything. It quietly takes a third of your life's work, while every statement you receive shows a bigger number than the year before. The hard asset sleeve is the entire story. Gold was fixed at $35 an ounce when Nixon closed the gold window in August 1971. By late 1979, it was around $500, and it touched $850 on January 21, 1980. Run the three sleeves across that decade, and the portfolio roughly triples in real purchasing power. I want to slow down there because that number is doing something specific. 2 decades, 1929 and the 1970s, that broke money in exactly opposite directions, deflation and inflation, and the same fixed allocation, never changed, never traded, came through both. That's not because the weights are magic. It's because you don't need to know which decade is coming. You need to own something that wins in each one. Same setup, different number. Let's do 2008. The S&P 500 lost about 37% that year. 10-year treasuries gained 20%. Gold rose modestly, roughly 5%. Cash earned almost nothing. The three-sleeve portfolio finished 2008 down about 17%. A standard 60-40 finished down about 20%. All stock down 37%. And here's where I stop selling. 17 versus 20 is not a triumph. That's a 3-point edge in the worst credit crisis since the Depression. In 2008, the framework barely won, which is exactly why I trust it more than if it had crushed it. But go back to Claire and Marcus, because the 3 points on the statement are not the real gap. It's February 2009. Claire's hours get cut. Her $11,000 in checking is gone in 7 weeks, and the only place left to get money is the account that's down 37%. So she sells. Not because she panicked, because the mortgage was due. That's the part the charts never show you. Most people who sell at the bottom aren't emotional, they're out of cash. Marcus has a quarter of his portfolio in treasury bills. He spends some of it. He sells nothing. In March, he does his annual rebalance, which mechanically forces him to move money out of the sleeve that held up and into equities at prices nobody wanted. Same crisis, same salary, same suburb. Claire realized the loss and rebuilt from a smaller base. Marcus didn't, and bought the bottom without ever deciding to. Put a number on what that reserve sleeve is really worth. $1,500 a month, invested at 8% for 30 years, is about $2.24 million. The single decision to not liquidate that engine in one bad quarter is worth more than any fund selection you will make in your life. Before anyone tells me 8% is generous, at 7, it's still about $1.83 million. The argument doesn't change. The reserve sleeve isn't there to earn. It's there so the other 2 sleeves never have to be sold on someone else's schedule. Here's the honest other half. This portfolio costs you money. Not in a crisis. In every decade that isn't one, which is most of them. Take $1,000 a month for 30 years. In an all-stock portfolio compounding at 10%, you end with about $2.26 million. Run the same $1,000 a month through 25-50-25, where half the money grows at equity rates and the other half deliberately doesn't, and you end around $1.46 million. That's a gap of roughly $800,000. Read that again slowly, because that's the actual price tag. This isn't a free lunch with a clever historical story attached. You are buying insurance, and the premium is $800,000 over 30 years. Before anyone writes that 10% is optimistic, fine. At 7%, the all-stock number drops to about $1.2 million, and the gap narrows sharply. The more pessimistic you are about equities, the cheaper this framework gets. That cuts my way, so I'll flag it rather than lean on it. Now the part I promised. The year it failed. Stocks fell 18.1%, including dividends. Treasury bonds lost 17.7%, worse than stocks, which is not supposed to be possible in a portfolio built on the idea that they zig when stocks zag. And gold, which had risen in every single year since at least the 1970s that U.S. stocks dropped 10% or more, finally didn't. It slipped 0.3%. All three sleeves, at once, in the same 12 months, while inflation ran at 6.5%. The three-sleeve portfolio lost about 14% of its purchasing power in 2022. It beat 60-40, which lost about 21. But it lost, plainly. And any version of this video that skips that year is a sales pitch. And it's worth understanding why it failed, because the reason is specific and it tells you when to expect it again. 1929 was a demand collapse. The 1970s were a currency problem. Both of those hit some assets and spared others, which is precisely the condition a three-sleeve portfolio is designed for. 2022 was neither. It was a repricing of the discount rate itself, the number underneath every asset on Earth. When the rate that values everything moves that fast, everything reprices together, and diversification across asset classes stops helping, because for a few quarters there is only one asset class. That's the honest boundary of this framework. It handles regime changes. It does not handle a simultaneous repricing of all regimes. So what does 2022 actually teach? That this framework is not built to stop losses. It's built to stop ruin. Those are different products. A 14% bad year is something a household recovers from in 18 months. An 89% decline that takes 25 years to repair is something a household does not recover from at all, not because the market never comes back, but because people sell, and because life happens on a schedule the market ignores. Push on this for a second, and you'll see why sequence matters more than average. The retiree who hit 1973 with an all-stock portfolio and started drawing income wasn't wrong about the long run. The long run was fine. They just weren't in it anymore. Zoom out, and the pattern across all 4 episodes is the same. In 1929, one sleeve carried it. In the 1970s, a different sleeve carried it. In 2008, the sleeves roughly canceled and the portfolio limped through. In 2022, nothing carried it and it took the hit. The framework never wins because it predicted anything. It wins because it never needed to. So here's how you actually build it. 3 steps, and I do them in this order. Step 1. Count what you already own before you buy anything. Most people are far more concentrated than they think. Add up your 401k, your IRA, your brokerage account, your company stock, and, this is the one people forget, the equity in your home. For a lot of households, home equity alone means the hard asset sleeve is already close to full, and the real gap is liquidity. You cannot allocate a portfolio you haven't measured. Step 2. Build the reserve sleeve first, and build it in the boring places. Treasury bills, a money market fund, short-duration treasuries, I-bonds. This is not the fun sleeve. It is the sleeve that meant a household in 1932 could pay rent without selling stocks at 41 on the Dow. Its job is not return. Its job is to make sure you are never a forced seller. If you take one thing from this video and ignore the rest, take that. Step 3. Rebalance on a schedule, not on a feeling. Once a year, on a date you pick in advance. Your birthday, January 2nd, whatever. Bring the 3 sleeves back to 25, 50, 25. This is the step that quietly does the work, because it forces you to sell whichever sleeve just had a great year and buy whichever one everybody currently hates. In 1932, that meant selling gold miners to buy stocks at the exact bottom. Nobody wanted to. That's the point. A calendar has no feelings, and yours will be wrong at precisely the wrong moment. 3 steps. None of them require you to have an opinion about the next 10 years. And that's what separates Claire from Marcus. Not intelligence, not discipline, not a better fund. Claire built a portfolio that was correct about one future. Marcus built one that was adequate in 4 of them. In the decade where Claire is right, she beats him and she beats him clearly. That's the $800,000. In the decade where she's wrong, she doesn't get a second attempt. Because she's 68 by then, and the recovery takes longer than the runway. Claire isn't reckless. She's concentrated, and she doesn't know it, because concentration in the thing everyone else owns doesn't feel like a bet. It feels like the default, and that's the durable lesson underneath all of this, so let me put it plainly. Look at what actually happened across the last century. 1929 rewarded liquidity and hard assets. The 1970s rewarded hard assets and punished everything nominal. 2008 rewarded government bonds. 2022 punished all three at once. 4 regimes, 4 different winners, and not one of them was forecastable from inside the decade that preceded it. In 1928, the smartest people in America believed stocks had reached a permanently high plateau. In 1970, nobody was positioning for the dollar to lose half its value. In 2007, the safest thing in the world was a portfolio of mortgages. The households that came through each of those didn't call the top. They just never had all of it in one thing, and they never had to sell at the bottom. That's the entire mechanism. Every era's survivors did the same 2 things, and neither of them was prediction. Which is why understanding how money has behaved matters more than any specific allocation, including this one. I've built a full breakdown of how ordinary people built wealth in every era of the last 100 years. What worked, what only looked like it worked, and what still applies. It's the foundation underneath this video, and it's free. Start there. So, back to the 2 portfolios I opened with. 60/40 lost about 16% of its purchasing power across the 1970s and had its 3rd worst year on record in 2022. The 3-sleeve version was down 7% through the Great Depression, roughly tripled through the 70s, limped through 2008 by 3 points, and still lost 14% in 2022. It is not the best portfolio in any single decade. It has never been the best portfolio in any single decade. It's the one that was still standing at the end of all of them. One last thing, and it matters. I'm not your advisor, and this isn't personalized advice. I'm a guy who reads the archive and shows you what's in it. Your situation has a tax code and a timeline attached, and mine doesn't. If you want the next one in this series, tell me in the comments which sleeve you're furthest from. Hard assets, productive assets, or reserve. I'll build the next video around whichever one comes up most. Money has misbehaved in the same handful of ways for a century. The savers who saw the pattern won. The ones who didn't paid the bill.